Canadian inflation numbers were released at 8:30 a.m. Eastern Time this morning. The December Consumer Price Index changed by 1.8%. That was the increase to the pace of inflation in terms of year-over-year price growth. Let's talk about it with an expert. It was heavily influenced, for one thing, by the GST tax holiday, which took place in the middle of December. We're joined now by Benjamin Reitzes, Managing Director of Canadian Rates and Macro Strategy at BMO Capital Markets. Benjamin, thanks a lot for joining us. What does the inflation picture in Canada look like, or what did it look like in December, absent that tax holiday, which is going to continue to skew the numbers for at least a couple of months?
Well, thanks for having me. The tax holiday did have a very big impact. You had big declines in food prices, clothing prices, alcohol prices, all down very sharply. But once you exclude that, it's not quite as rosy of a picture. If you look at the core inflation measures, they were not all that weak. You had a plus 0.2 and a plus 0.3 on the two different core measures the Bank of Canada looks at. They're sitting at about 2.5% year over year. They've been sticky in that range, and what we've seen over the past few months is you've had a little bit more strength than what the Bank of Canada would like to see. And if you look at their October forecast from their monetary policy report, core inflation has outpaced what their forecast was. So not great news on inflation. And if you really just take out the tax factor altogether, look at overall prices on a seasonally adjusted basis, they were actually up the most since August 2023. And so overall, I mean, the tax holiday had a big impact, but the inflation news was not great today.
Seemed to be pretty good on grocery prices. We all remember, it wasn't that long ago, a year, 18 months ago, where food and grocery inflation was running at 8-9%, and that was putting a heavy burden on lower income Canadians who must go to the grocery store and buy groceries. It ran at only 1.9% in that in the month of December. Now groceries are part of those they're one of those volatile items. That's why we have core inflation, which excludes the impact of, among other things, grocery prices. But talk to us about this dramatic come down we've seen over the past year and more in grocery prices.
Well, supply chains healing have been a big factor there, and just broadly dampening inflation pressures have helped as we've moved further away from the pandemic. So that's been a big factor. I mean, the tax holiday, also a big factor in this month. That's what drove a further decline. Food prices were down well over 1%, and that helped the month. You're going to see something similar next month again. You have to keep in mind that for the Consumer Price Index, the tax holiday only came into effect in mid-December, so you have about 18 days in which it impacted the CPI. That's not a full month. You're going to get another 13 days worth of that next month for January. So food prices probably fall further, and you get a further slowing of that food inflation, which is a positive. There's no doubt about that. However, this tax holiday ends in mid-February, and you're going to get the reversal in February and then again in March. And so while there is some relief for the moment, it is going to we are going to see a rebound in the first quarter of this year.
Your colleague, Doug Porter, has written a note on these numbers, and he says near the end of that note that possible U.S. tariffs override almost everything else in terms of the inflation outlook. Talk to us about that.
I mean, well, he's got it right on. There's no doubt right now that even with the inflation numbers that weren't great, it still looks as though the Bank of Canada will cut rates next week. The cloud of tariffs is dark. It is significant. It is a large risk to the economy. Right now, it's anybody's guess as to when they'll come. President Trump said February 1st, 25%. If that's the case, the Bank of Canada will surely want to get ahead of that. But the reality is we don't know. And even if they don't come February 1st, just the uncertainty that it's creating is enough to dampen Canadian economic activity. And the reality is the Bank of Canada already had an easing bias. They were already looking to cut rates further. And so you have this big potential negative cloud over the economy, and with them likely cutting more anyways in the relatively near future, a January rate cut does make some sense here, at least from a risk management perspective.
The Bank of Canada has now cut rates 5 times. The overnight rate stands at 3.25%. Where do you and your colleagues at BMO believe the bank is going in this cutting cycle?
Right now, we have it as a base case going down to 250, but it's going to depend heavily on tariffs. And if you get those 25% tariffs, that probably means much deeper rate cuts from the bank. If you get something milder, that 250 could look pretty good, or maybe a no tariff scenario. Maybe they don't get all the way down there, and it's going to depend a little bit more on what happens in the U.S., what happens with the Federal Reserve, because rate spreads have moved against the Canadian dollar pretty sharply. The loonie has weakened an awful lot, and there does come a point where it will become an issue for the Bank of Canada. They mentioned it a little bit more with a little more emphasis in the last minutes that we got from them, and so they're paying a little more attention than they have in the past. We're not there yet, but we're probably close to that point where Canada-U.S. policy divergence is at its limits.
Benjamin, thank you so much for your insight. Benjamin Reitzes is Managing Director at BMO Capital Markets.